Hi class, today's video is going to move on to chapter 10 and which is all about how we close accounts in the general ledger. But this specific video is really going to focus on the question above, what is profit? So we're not going to go through transactions, but we're going to think about what is profit. And before you move on and go, I know what profit is, I don't need to watch this video, it will be a useful activity to watch this video to really get a deep understanding about what we mean about profit in Year 12 accounting, how we calculate it, and also how we report it. It might be slightly different to how you think of profit when you use it in everyday language. Before we do that, I do want you to think about what you think of when you think of profit. So what is profit when you're thinking about it? What is profit for Year 12 accounting? This equation. Profit equals revenues minus expenses. And again, you can't stop this video and go, yep, I've got it. It is more complicated than that. To really understand profit and be able to calculate it and report it, you need to understand what is a revenue or an expense in accounting. When we are identifying revenue, we actually have 3 tests that we need to tick off. We need to tick off all 3 for that part of the transaction to be revenue. Those 3 tests are as follows. It must be an inflow of an economic benefit or a saving of an outflow, but we really focus on, is there an inflow of economic benefit? Is something coming in to our business, inflow, that is going to benefit us economically? So is it going to increase our cash or something like that? It also must result in an increase in assets or a decrease in liabilities, but 99% of the ones we're going to see in Year 12 accounting, will this be an inflow that increases an asset? What are some of the inflows that increase assets? Increases in cash, increases in inventory, increases in accounts receivable, for example. Not everything that increases cash is revenue, because it also must result in an increase in owner's equity, except for capital contributions. So there really is a 4th test. Capital contributions, as we know, are not revenue, even though they do increase owner's equity. So you need to tick off all of those 3 things: an inflow that increases an asset, that also increases owner's equity, for it to be revenue. Expenses also have 3 things that need to be ticked off, and they're essentially the opposite of the 3 tests for revenue. It must result in an outflow or a consumption of economic benefit. So something must leave our business or be consumed that is an economic benefit. Must result in a decrease in assets. So for example, does this expense lead to a decrease in cash or a decrease in inventory, for example? And it also, again, must result in a decrease in owner's equity. And it can't be a drawing. So there's a 4th one. So if we look at revenue, we can start to use these 3 tests to identify things that aren't revenues. If I take out a loan, this results in an inflow of economic benefit. There is an increase in cash in the business, an inflow of cash. It results in an increase in assets because we have more cash. So we tick off the first 2. Why is taking out a loan not revenue? And we know taking out a loan is not revenue because it doesn't result in an increase in owner's equity. The impact to our accounting equation, our assets go up, our owner's equity stays the same because our liabilities go up. So we can't tick off the 3rd one, so it's not revenue. And there are examples for expenses like that as well. Things that aren't expenses. For example, purchasing assets results in an outflow of economic benefit. We've paid it with cash. However, it might not result in a decrease in assets because When cash goes down, another asset goes up. So it doesn't tick off the expense requirements. So this is what you're going to be thinking about. Once we've done that, we can then start to think about how we calculate and report it. And this is where we consider all the accounting assumptions and qualitative characteristics that are important. I'm going to talk about 3, but really, because profit is such an important part of accounting, all of particularly our characteristics are relevant. What are 3 that are particularly important? The accrual basis assumption, this is an accounting assumption, is integral. Probably the most important one. This says that we must record revenue when it is earned and expenses when they are incurred. Not necessarily when they're paid for, but when we earn things or incur them. So if we use up some electricity in our business, that is an expense. Even if we don't pay that bill for a while, we will record the expense as soon as it happens. This is important for profit, so it means that we match revenues earned in a reporting period against expenses incurred in the same reporting period. Also important, you probably guessed from the last couple of words in the first one, period assumption, incredibly important. Financial activities are recorded and reported for a particular period of time. The accounting records should reflect the profit that has occurred in the reporting period. And finally, relevance, always important. The information that we give about profit must be useful and help users in decision making. This ties it all together because if we ensure that we match and only include revenue and expenses that have incurred in the reporting period, we're going to give information that's useful for decision making. So 3 important ones that you might talk about in your questions. Accrual basis, probably the most important one. But timeliness, understandability, relevance, faithful representation, comparability, even verifiability all come into our profit reporting. So how do we report? We report profit in an income statement. And you can see in this document, the income statement, and you can see that we have revenue at the top, and then we start to list all the expenses. We have lots of different types of profit that we report: gross profit, net profit. These are different concepts. And you're probably starting to see a number of these things that you've learnt about, such as inventory loss, cost of goods sold, cost of sales, all of your other expenses. And this might look a little bit intimidating, a little bit complicated, but we will get experts at this not in chapter 10, but we cover income statements in chapter 11. But now that you understand profit, how it is calculated, how we report it, things that are important to consider, you will now be ready to close accounts in the general ledger, which is the first step to be able to create this income statement. Well done for listening to this video. Now's the time to watch the video on how to close general ledger accounts and begin your process of calculating and reporting profit.